Admitted now.
Admitted now? Okay. Good morning to all. Good evening. Sorry. Good evening to all the participants, to the dignitaries, speaker for the day, Surendra ji Kanstiya, and keynote speaker, Balkishan ji Agarwal. Ritu madam, we may commence now, please.
Yeah. Thank you, Nikunj. Good evening, members, and a very warm welcome to this 20th VCM of Bhayander CP Study Circle. Hope you people are doing well and are in good health. So our today's topic is Companies Act 2013, Compliance for Private Limited Companies, which is most relevant topic at this time since many changes are taking place. I see Ritu Agarwal, Deputy Convenor, Bhayander CP Study Circle. Welcome our dignitaries to this VCM, CA Balkishan Agarwal ji, RCM WIRC of ICAI, and our today's speaker CA Surendra Kanstiya sir, our immediate past convener CA Amit Agarwal, and convener CA Nikunj Bhangaria. Welcome you, sir. I request Nikunj bhai to present opening remark for today's session to formally begin the session. Nikunj bhai, over to you.
Thank you so much, Ritu madam. Very good evening to all the members, the dignitaries, once again. I hope and I wish all of you great health. And as you all know, we had planned this session last Sunday, but due to sudden ill health of Surendra ji, we had to postpone this. But sir, as you must have come to know now that we are very, very stubborn in not letting our faculty go anywhere unless we have had his share of knowledge and wisdom. So we are back again today and looking forward eagerly to hear you, sir. I also welcome CA Balkishan ji Agarwal for accepting our invitation as the welcome note speaker on such a short notice. I know, sir, you must be busy, and I thank you for sparing out time for sharing your views and vision with us. Members, as you all know now, we are all now on the path of recovering, returning back to our, the full-fledged professional lives, personal lives, and getting back to normal. But I hope you are taking all the precautions that are necessary to keep yourself safe and sound. With this, I wish you all the best and wish you the best of the knowledge that is going to be shared today. Thank you. Over to you, Ritu madam.
Thank you, Nikunj bhai. Friends, it's our pleasure to have with us dynamic leader K. Balkishan Agarwal ji. Sir is practicing chartered accountant at Surat. Presently, he is a regional council member in Western Regional Council of ICAI. He was the chairman of Surat branch of ICAI in 2015. He was the treasurer of WIRC in previous year, 1819. He is also associated with lots of NGOs and doing work for upliftment of society. With this, without taking much of time, I request sir to enlighten us with his learned thoughts and vision. Over to you, sir.
Thank you very much, Ritu. And first of all, thank you very much, Nikunj, the convener of Bhayander CP Study Circle, Ritu, the deputy convener of CP Study Circle, and all the members of Bhayander CP Study Circle for giving me this opportunity or share my words with the member of Bhayander CP Study Circle. And also thank you very much, Amit Agarwal, the immediate past convener of Bhayander CP Study Circle. And no doubt, Bhayander CP Study Circle is doing very well and conducting very good seminars with very learned speakers. And especially in this year, in this virtual mode. So very good topics you have covered in past. And you already mentioned this is the 20th webinar in this year. So my best wishes is always Bhayander CP Study Circle and all the members presenting here. And no doubt in this COVID situation, there are some limitations, But my point of view, though major benefits we have in this virtual mode webinars, first of all, by devoting less time, we gain more. And especially for Mumbai's started accountants, averagely they are 2 to 3 hours conveyance time you have to spare to attend 2 to 3 hours CP program. But in this situation, within 2 hours we get the result of 2 hours webinar. So this is very positive uh, note for this situation. And secondly, by CP Study Circle, it is hard to find a very renowned speaker on the physical platform. But in virtual mode, we can invite any speaker through Pan India. And no doubt, Bhayander CP Study Circle take this benefit and inviting very renowned speakers for their members. So these are the positive side. And being RCM, I frequently visited at Mumbai and interacted with lots of members from Mumbai and the City Study Circle. And personally, I have learned lots of things from Mumbai. And being a regional council member, I am always available for each and every member for any queries, any help, any suggestions. So you can contact me. And this and friends, in this situation, I think this is very good time to learn new things, to develop our new skills, hidden skills, and sharpen our skills. And frankly speaking, मैंने इस situation में I have learned, and I get up at 4 a.m. daily in the morning, and I devote 1 hour time on yoga and meditation, 1 hour on physical exercise and running and walking 8 kilometers. And this have beneficial lot for me. So this is not the one thing. You can adopt any good habits, any new things in this situation. So this is my humble request to all the members. And today topic is also very important and relevant topic. The Companies Act 2013, the important compliance for private limited. And Surendra sir is with us, and definitely he will cover all the concepts and things related to that, and answer all the questions related to that topic. So thank you very much for giving me this opportunity. And I request all the members always focus on the solution instead of raising the problem. So stay safe, stay positive, and invest your time very properly. So thank you, Ritu. Thank you, Nikunj.
Thank you, sir.
Yes, hand over to Ritu.
Thank you, sir. Thank you so much for your words of wisdom and your encouragement towards making us aware towards our health. So we thank you again for giving your precious time for benefit of our members. Your presence has certainly acted as an encouragement for our study circle. Thank you so much. So before moving to technical part of our today's session, I request CA Kishore Mehta, Coordinator, Bhayander CP Study Circle, to give formal introduction to our today's speaker, CA Surendra sir.
Yeah, yes. Thank you, Ritu, for giving me this opportunity to introduce Surendra Kanstiya. Surendra ji Kanstiya is a BCom LLB in FCS. He is a practicing company secretary. He is the only CS to hold post membership qualification in competition law of the Institute of Company Secretaries of India. He is also a fellow member of CUTS Cut Center for Competition, Investment and Economic Regulation. He has authored 6 books and reviewed 9 books. His review book includes classic publication-led 6th edition of Duggar's Guide to Competition Law, 2 volumes, 24th edition of Bhandari's Guide to Companies Law Procedure, 4 volumes, and 4th edition of Dr. Chandate, a Company Secretary's Practice Manual. He is also contributed over 200 articles in leading journal like Chartered Accountant, Company Secretary, Management Accountant, Corporate Law Advisor, SEBI, corporate law, taxman, financial express, etc. He served as a Consumer Guidance Society of India as a General Secretary, Vice Chairman, and Chairman. He has also served on Governing Council of Consumer International, and presently he is the member of Steering Committee of International Network of Civil Society Organization on Competition. With this, Surendra ji, the platform is yours. Yes, sir. Yes. Hello.
Can I start now?
Yes, sir.
Okay. RCM, CA, VK Agarwal ji, my good old friends Amit, Nikunj, and Ritu. I'm happy for getting this invite to talk to your members on the Companies Act 2013 with reference to the private companies. As we are all aware that the new Companies Act, which was passed in the year 2013, is 7 years old, and now it's become a huge body of knowledge. To give you a quick overview, it has 30 chapters. Number-wise, there are 29, but then again, a new chapter which has been added in the very recent past, which has been numbered as 21 capital A. The total makes to 30. It has over 500 sections, 7 schedules. There is a special phrase which appears in this act very often, and that is as may be prescribed. Now, wherever this term as may be prescribed appears in the act, the impact thereof is that you have to bank on the relevant rules. And talking of rules, again from the year 2013 till now, we have about 45 set of rules released by the government from time to time. And these rules have been amended for over 200 times in the last 7 years duration. So in all, the moment you talk of the rules, you have to practically refer to about 250 documents, the principal rules and the rules which have been amended from time to time. About 21 orders have been issued by the central government to again enforce various provisions of the Companies Act 2013. Of course, the most popular order which has been a favorite of all the chartered accountants is the CARO, Companies Audit Report Order now 2019, which is to be enforced with effect from the accounting year commenced from 1st April 2020. We have about 300 circulars and notifications issued by the central government pursuant to this act from time to time in last 7 years. There have been exemption notifications issued with reference to the operations of the private companies, the government companies, Section 8 companies, Nidhi companies. We also have secretarial standards issued by the Institute of Company Secretaries of India. Secretarial standard number 1 on board meetings and the secretarial standards number 2 on general meeting is having a mandatory force, and it's binding for all the companies who are to be covered by the applicable standards. And we have large number of judgments delivered by NCLT, that is National Company Law Tribunal, NCLAT, that is National Company Law Appellate Tribunal, and the Supreme Court from time to time. So if you see this slide, it gives you an overview as to how huge is the body of knowledge called the Companies Act 2013. And this act, which was passed in the year 2013, has witnessed 4 major amendments. The first amendment took place in the year 2015, when 23 sections were amended or added. The second major amendment took place was in the year 2017, whereby 93 amendments took place. A number of new sections were added, a number of existing sections were amended, and few sections were repealed or deleted also. Then we saw another act, which was in the form of the Companies Amendment Act 2019, which was preceded by the Companies Amendment Ordinance of 2018, followed by the Companies Amendment Ordinance of 2019, followed by Companies Second Amendment Ordinance 2019, finally to be converted by the law in the form of the Companies Amendment Act 2019, which introduced about 44 changes. And then the latest one, which happened about a month back, is the changes introduced by the Companies Amendment Act 2020, whereby 65 sections were introduced. The major push through the Companies Amendment Act 2020 was the inclusion of the chapters on producer companies. According to the earlier set of provisions, the producer company related chapter from the Companies Act 1956 was to be complied by all producer companies. But through the Companies Amendment Act 2020, the government has brought the chapter on producer companies also in the Companies Act 2013 itself. And as I said earlier, we have about 45 set of rules which have been amended about 200 plus times to take care of all the provisions which are to be prescribed by the central government from time to time. Because of the fact that the act can be amended only by the parliament, and parliament has many more other things to do, they have thought it appropriate that, okay, let's delegate the powers of amending the law through the rules. And therefore, exercising those authorities, the central government keeps coming out with numerous rules and keep amending the rules. There's a long list. I've just given you a list. It starts, and again, every set of rule is pursuant to a specific chapter. So you can see the rules which have been classified. Chapter 1, we have 2 sets of rules. Chapter 2, 1 rule. Like if you go to chapter 8, you have 3 sets of rules. So again, the chapter 8, which relates to dividend, we have different set of rules for the payment of dividend, for the Investor Education Protection Fund, for the office bearers of Investor Education and Protection Fund. That's how separate rules have been framed and notified by the government from time to time. The list continues. The list still continues. And as I said earlier, the provisions relating to producer companies, the new chapter has been added about a month back. We have to be geared up to get many more set of rules to take care of the provisions with reference to the producer companies as well. And in view of this background, the only suggestion which I keep sharing with my professional friends is that please don't go by a prima facie interpretation of the provisions of the law. Whenever there is an issue on hand which needs to be discussed and decided, it's better to go to the roots. And it does happen that we come across a particular problem which took place in the year 2018 or 2017 or 2016 or maybe 2019. We cannot rely on the provisions which are enforced today. In view of the fact that the rules have been amended about 250 times and so many notifications and circulars have been issued from time to time, it's better to go back to the date when the actual problem happened. And we need to see as to what were the prevalent provisions at that point of time. It's no point using the provisions which is in force in 2020 to a problem which was relating to the year 2018 or 2019. In addition to the rules, we also have various forms to intimate the authorities about happening of various events or taking various approvals from the authorities. And for these purposes, we need to file various forms. These forms also have been prescribed in the respective rules. And the speciality of the Companies Act 2013 is that under every rule, the forms which have been prescribed carries a small set of letters from the relevant chapter. So like under Chapter 1, which relates to companies incorporation, Chapter 2, which relates to companies incorporation, the rules are named as the Companies Incorporation Rules 2014. And all forms which have been prescribed under this set of rules are numbered as INC 1, INC 2, INC 3. We have about INC up to 28, 29. Similarly, forms relating to the chapter on prospectus and allotment of securities, the forms are numbered as PAS 1, PAS 2, PAS 3. On like acceptance of deposit, the forms are numbered as DPT1, DPT2, DPT3. Relating to accounts, favorite topic for you all, the forms are numbered as AOC1, AOC2, AOC3, AOC XBRL. Again, for appointment of auditors, etc., we have the forms relating to like ADT1 for appointment of auditor, ADT3 for resignation of auditor. Different forms have been prescribed. So this is again a very special feature of the new Companies Act 2013, that you name the form and you can correlate it to the chapter concerned. Like if the form is MBP1, that means it relates to the Meeting and Board of Its Powers Rules 2014. These are all the forms. And that brings me to a quote from Alvin Toffler, that illiterates of the 21st century will not be those who cannot read and write, but those who cannot learn, unlearn, and relearn. Simply in view of the fact that these rules are being amended from time to time, we need to keep learning, unlearning, and relearning. All my friends who are 50 plus and who have lived in the Companies Act 1956 era have to take a very tough decision to unlearn the provisions of 1956 Act. Yes, that subconscious wisdom would be helpful to you in interpreting the new provisions, but we cannot bank on the knowledge relating to our 1956 Act era. Why did we decide to focus on the private companies? The reason is given on this slide. According to the Ministry of Corporate Affairs, as of 30th September 2020, in all, there were 12,23,841 companies limited by shares were in existence in India. And of this lot, only 64,804 companies were public limited companies. And out of these 64,804 public companies, 6,776 were listed and 58,028 were unlisted public companies. And remaining 11,59,037 were the private companies, of which only 31,884 were the one-person companies, OPCs as we call them. Otherwise, all private companies. So in view of the fact that about 94% companies limited by shares in India are from the private limited sector, and again, ask any practicing chartered accountants about the number of companies being audited by him or her, answer would be about 60-65% companies are private companies. And therefore, we thought that let's have a focused discussion on private companies, because there are numerous provisions which are not applicable to private companies, but unknowingly, we end up making those private companies also comply with those provisions. There are exemptions which are at times ignored, and therefore, it was decided that, okay, let's have a focused discussion. How the private company is defined under the Companies Act 2013. We have section 2(68), which gives the definition of a private company. This definition also is not the one which was originally there in the Companies Act 2013. This definition has been amended, and it says it means a company having a minimum paid up share capital as may be prescribed. Originally, as you all remember, it was 1 lakh rupees. But then through the Companies Amendment Act 2017, they said, let's not have a minimum threshold for the capital requirement. And they said, as may be prescribed. So as on today, there is no prescription about the minimum threshold. And hence, every company which is to be formed as a private company is at its liberty to have any amount as the minimum paid up share capital, something which was there in the earlier act for a long duration. And the speciality of a private company is that through its articles of association, it is allowed to restrict the right to transfer of shares. Why this particular privilege is given to a private company? It's connected to the next point, that except in case of a OPC, the private company limits the number of its members to 200. So a private company is not allowed to have more than 200 members by the statute. But again, when we take this total of 200, we are to ignore certain members, certain categories. Joint holdings are to be treated as one. There are cases where shares are held by 2 or 3 individuals jointly or entities jointly. In that case, they are to be treated as a single member, like we call portfolio per member. And the members who are in the employment of the company, if they are holding shares, they will not be treated as a member for the purpose of this total of 200. Or the past employees also will not be treated as a member for the purpose of this calculation of 200. And a private company is prohibited to invite for the subscription of securities by the members of public. It is supposed to be a private body. And this particular set of definition has to be spelled out very clearly in the Articles of Association. The Articles of Association of a private company has to start with the fact that the company is a private company within the meaning of Section 2(68) of the Companies Act 2013, and therefore, and then these conditions are to be spelled out. There's a only rather major difference between Articles of Association of a private company and a public company. In case of a public company, absence of this clause means it is a public company. And a public company is allowed to have model set of articles like table F can be followed. Table F can be followed by a private company also. But in addition to following table F, a private company has to very clearly spell out in the articles that the company is a private company within the meaning of section so and so of the Companies Act, and therefore, and all these 3 conditions are to be given. Then it's better to quickly rush through the definition of the public company also. Section 2(71). Public company means a company which is not a private company. So any company which is not a private company is a public company. Which company is a private company? A private company is a company which by its articles carries a clause saying that we are a private company within the meaning of bracket 2(68), etc., etc. And it has a minimum paid up share capital as may be prescribed. As of today, there is no such prescription. So you are allowed to have incorporate a public company with any amount of minimum share capital. Of course, you will have to keep in mind that you have to have minimum 7 members in a public company, and you have to allot at least 7 shares of whatever amount you deem appropriate. And there is a provision in this section. It says that the company which is subsidiary of a company, not being a private company, shall be deemed to be a public company for the purposes of this act, even where each subsidiary company continues to be a private company in its article. Little complicated, but in short, if a private company happens to be a subsidiary of another public company, in that case, that private company will also be deemed to be a public company. That private company will have to follow all the norms which are prescribed in the act for compliance by a public company. The moment a private company becomes a subsidiary of a public company, it is no longer a private company, but yes, the only privilege which is given to such a private company which is subsidiary of a public company is that it can continue to have those 3 restrictions which are spelled out in the definition of the private company. And there is no need for such private companies or subsidiary of a public company to amend their name. But if a private company is a subsidiary of another private company, in that case, the subsidiary would not be treated as a public company, because the provision very clearly says a company which is a subsidiary of a company which is not a private company. So if a private company is a subsidiary of another private company, then that subsidiary would not be treated as a public company. Another definition which is important for today's discussion is definition of a small company given under section 2(85). It says it means a company other than a public company, which means a small company has to be a private company. Only a private company can have a privilege to be called a small company. The further conditions, it has to have a paid up share capital which does not exceed rupees 50 lakh or such higher amount as may be prescribed. As of today, no such prescription has been issued in the rules, and therefore a small company would be a company which does not have a paid up share capital of more than 50 lakhs. And again, lawmakers have deemed it appropriate that even through prescription, the highest amount or higher amount cannot go beyond 10 crores of rupees. Capital is not the only criteria. In addition to the capital of not less than 50 lakhs of rupees. The small company, a private company would be treated as a small company only if its turnover as per the P&L account for the immediately preceding financial year does not exceed rupees 2 crores. This amount of 2 crores can be enhanced through amending the rules. But again, through this enhancement, the upper limit cannot go beyond 100 crore. So a small company which has a paid up capital of less than 50 lakhs and whose turnover is less than 2 crore would be treated as small companies. The moment a private company is a small company, it has few more privileges available to it. But again, there is a proviso that a private company which is holding or subsidiary of any other company, or a private company which is registered under Section 8 of the current Act or under Section 25 of the previous Companies Act 1956, or a private company or a body corporate which is governed by any special act. In that case, such companies, even though they have less than 50 lakhs paid up capital, they have less than 2 crores turnover, cannot be termed as small companies and they cannot enjoy those privileges. The moment we talk of any special act, well, again, you are familiar, special act are defined with reference to the accounting provisions also, like insurance companies, banking companies, electricity companies. They are the companies who are regulated by special act, or like State Bank of India, those kind of companies which have been regulated through some other special act as well. Now, because of the fact that the Companies Act has been amended in the recent past, I just thought of taking 2-3 provisions which affect the private companies directly. The first is the amendment of definition of listed company. The Companies Amendment Act 2020 has amended the definition of the listed company. Section 2(52), a proviso has been added to the definition of a listed company, and this proviso reads as, provided that such class of companies which have been listed or intend to list such class of securities as may be prescribed in consultation with the SEBI shall not be considered as listed companies, which means certain companies which have listed their securities on the stock exchange still would not be treated as a listed company if those classes of companies are so spelled out by the central government through drafting the appropriate rules. Now, explanation of this proviso has been very beautifully given by a note appearing on the portal of the Institute of Chartered Accountants of India, and therefore I thought, let me copy the same. This particular proviso, which has been explained by CA Institute in the following manner, the objective of according such flexibility is to exclude such private companies, and our discussion for the day is private company. In fact, it happens that a private company comes out with certain instruments which are listed on the stock exchange. The moment a company's instruments are listed on the stock exchange, it is supposed to comply with various norms, especially the LODR, which was released in September 2015, a huge document, and compliance becomes a really tough task for a private company. So to exempt those categories of companies, I repeat what CA Institute has said, the objective of according such flexibility is to exclude such private companies that list their debt securities on a stock exchange upon their allotment on private placement basis, thereby falling under the definition of a listed company under the Act. This can incentivize private companies seeking listing of their debt securities, and therefore, according to the prediction of the CA Institute, this amendment would give a big incentive to private companies to come out with listed instruments without complying with the connected compliances under LODR. Another provision which is bound to affect large number of, I think maybe 70% of the private companies would be benefited by this amendment, which is proposed under the Companies Act, Amendment Act 2020, Section 135(9). Now it says where the amount to be spent by a company does not exceed rupees 50 lakhs. The requirement of constitution of CSR committee shall not be applicable, and the function of such committee shall be discharged by the board. Because again, you must be witness to this particular problem being faced by the private companies, where they are supposed to spend certain amount for CSR because of the application of the thresholds given under Section 135. But the fact is that such private companies have only 2 directors, and it's more of a family-owned company. However, to comply with the provisions of Section 135, they were required to form a separate committee, CSR committee. Again, both the directors would be on the committee also. So this kind of requirement would not be needed in case of private companies, especially. It's applicable to public company also, but I'm sure the big beneficiary would be the private companies with less than 50 lakhs to be spent on CSR in a particular financial year. Another new section, Section 446, capital B, which is introduced. I'm talking of the relevant clause. Section 446, capital B, as amended, it says, notwithstanding anything contained in this act, if the penalty is payable for non-compliance of any of the provisions of the act by an OPC or a small company or a startup company or a producer company, or by any officer of its officer in default, or any other person in respect of such company, or such company, its officer in default, or any other person as may be prescribed shall be liable to a penalty. The penalty shall not be less than, shall not be more than 1/2 of the penalty specified in such provision. So these companies, OPCs, small companies, startup companies, and producer companies, they will be required to pay lesser penalty. It says the penalty will not be more than 1/2 of the penalty specified in such provision, subject to a maximum of ₹2 lakhs in case of a company and ₹1 lakh in case of an officer who is in default or any other person. So with reference to these companies, OPC, small company, startup company, producer company, the liability for paying any penalty would be limited to the tune of ₹2 lakh in case of a company itself and ₹1 lakh in case of an officer in default or any other person connected with that particular contravention. Now, there is an explanation also which has been added to 446 capital B for the purpose of this section alone. It says producer company means a company which is defined under section 378 capital A bracket 1. As I said, a new chapter has been added which deals with the producer company. The startup company, and this is where we come to our today's discussion. Startup company for the purposes of this section means a private company. And therefore, the startup companies which are a private company incorporated under this act or under the Act of 1956 and recognized as startup in accordance with the notification issued by the central government in the Department for Promotion of Industry and Internal Trade. So all those startups which are private companies will also be eligible to avail this lesser penalty relief, but only those private companies who are operating as startup or as a small company. Other private companies will have to pay the penalty according to the prescribed norms. And then we come to the discussion for the day. Exemptions for private companies. Central government has issued 2 key notifications, one on 5th June 2015, which was perhaps the most welcome news from the Ministry of Corporate Affairs for us all. And then we got another dose in the form of a notification dated 13th June 2017. Through these 2 notifications, a number of privileges were given to the private companies. Of course, they came out with one more notification in July 2017, but it was for making a cosmetic change, and therefore I didn't put it in this. So mainly 5th June 2015 notification, 13th June 2017 notification have given a big relief to the private companies. We ended up saying at that time that happy days are here again for private companies, because before these notifications, practically the whole Companies Act 2013 was made applicable to private companies. Through the notifications, certain exceptions have been created, certain sections have been modified to the extent they are to be applied to private companies, and certain sections have been adapted. But before enjoying any of these privileges given in the notifications, one needs to keep in mind that a private company, while complying with such exceptions, modifications, and adaptations, shall ensure that the interests of the shareholders are protected. So the notifications are very clear that these exemptions are to be enjoyed only keeping the interests of the shareholders in the mind. If you go through various provisions of the Companies Act, you'll find that the certain provisions talks of interests of the company, certain provisions talks of the interest of the public, and certain provisions talks of the interest of the shareholders. These three stakeholders are dealt with differently under the whole Companies Act. So far as these exemptions are concerned, according to the notification, the interest of the shareholder needs to be treated as supreme. And again, the privileges shall be applicable to a private company which has not committed a default in filing its financial statements under Section 137 and annual return under Section 92. There are 2 annual forms which needs to be filed by every company every year, primarily on completion of the audit and on completion of the annual general meeting. And they are annual accounts in the form AOC 4, annual return in the form MGT 7. If a company has not filed any of these 2 documents, in that case, such company will not be eligible to avail any of the exemptions given under the notifications of June 2015 and June 2017. So this is something which needs to be kept in mind before enjoying or applying or thinking on banking on these exemptions. Now we go through these exemptions one by one. Many exemptions are very easy to understand. I won't spend much time, but wherever there are possibilities of interpretations, would go in little more detail. With reference to Section 240, it talks of financial statement. And I need not talk on this. Financial statement includes the balance sheet, the profit and loss account, the cash flow statement, and notes to the accounts, which are to be audited by the chartered accountants every year. With reference to this proviso, which appears in Section 240, 2(40), the privilege or the exemption is that a financial statement with respect to an OPC, a small company and a dormant company, these 3 category of companies were in any case exempt under 2(40) itself. Now the notification says that even a private company, if such private company is a startup, need not include the cash flow statement. So all those private companies who are startup companies have this privilege of not preparing and attaching the cash flow statement to its financial statement. The meaning of startup company also has been given in the notification itself. It says that the term startup or startup company means a private company incorporated under this act or the old act and recognized as startup in accordance with the notification issued by the Department of Industrial Policy Promotion, Ministry of Commerce and Industry. So only those startup which fulfill this criteria will be in a position to avail this privilege of not attaching the cash flow statement to its annual accounts. Related party, Section 2(76)(8). Now, if you related party, this must be one of the lengthiest definitions in the Companies Act 2013. It lists out certain parties who are to be treated as related parties. Certain individuals are included in it. Certain management people like managing director, manager, KMP, they are included in it. And then certain entities are included in this. Clause 9 says that any body corporate which is holding subsidiary or an associate company of a company, or a subsidiary of a holding company to which it is also a subsidiary, or an investing company or the venturer of the company. This class of companies which are included in the definition of related party under Section 2(76)(8), which happened through the Companies Amendment Act 2017 will not be applicable to a private company. So in simpler term, a contract by a private limited company will not be regarded as a related party transaction if it is entered into by a private company with its holding company or subsidiary company or associate company or co-subsidiary company or its investment company. These contracts need not be in compliance with the provisions of Section 188. You don't have to go through those processes. Section 43 will not be applicable to a private company. Clear exemption from the whole section itself. And that is in line with the provisions of the Companies Act 1956. In the 1956 Act, a private company was given a freedom to have its own method of designing the share capital. This privilege was withdrawn through the Companies Act 2013, and then representations were made, and finally government said that this section will not be applicable, and as the result thereof, a private company can have its own mechanism to design the financial instruments through the memorandum or articles of association. They can have their own norms. So the old privilege which was available for over 50 years in the old act is now given back to the private companies from 15th June 2015. And connected to the previous one is the designing of the voting rights. Again, a private company is given a liberty to design its own system of deciding voting right patterns. The whole section 47, which talks of voting rights, is not applicable to a private company. And whatever mechanism is defined and designed by the company concerned needs to be included in the memorandum or articles of association, depending on the structuring of the voting rights. Further issue of share capital, section 62. Section 62 deals with the further issue of share capital to the existing members. We call them rights issue in the day-to-day language. With reference to a private company, there are 3 privileges given through the notifications. First is section 62 bracket 1 bracket A bracket 1. It says that you are supposed to give not less than 15 days and not more than 30 days time. You are supposed to keep the rights offer open for this duration. Minimum 15 days, maximum 30 days. For a private company, an exemption has been granted that if the private company has taken approval from 90% of the members in writing or in electronic mode, in that case, a lesser period can be provided. And therefore, in private companies, because you have handful of shareholders, you know in advance as to who is to contribute how much money and all, then why wait for 15 days minimum and let that time lapse? Therefore, through consent from 90% of the members, you can reduce this 15 days duration to maybe 2 days, 3 days, 5 days, depending on the convenience. Another connected, section 62 bracket 2. Whenever you come out with rights issue, the notice shall be dispatched through registered post or speed post or electronic mode or courier or any other mode having proof of delivery to all the existing shareholders at least 3 days before opening of the issue. So practically you are wasting 3 days in this process. Again, relaxation has been given to private companies. If you have consent from 90% of the members, in that case, this 3 days duration shall not apply. You can go for 1 day, you can go for 2 days. Idea is that, okay, if all the family members only are the shareholders, and why wait for 3 days? You can give them the notice immediately and you can act on it on the very next day by passing another, or by taking approval in another form. You can also reduce the period of right issue to a duration less than 15 days and expedite the whole process of issuing further capital. One more privilege which is given under section 62 is that according to 62 bracket 1 bracket B, if you are coming out with offer to the employees under stock option scheme, the same has to be approved by the special resolution. But in case of a private company, if you want to come out with a scheme of offering shares to the employees in the form of stock options, this resolution from the members can be taken in the form of ordinary resolution, and there is no need to go for a special resolution. So these three are the privileges with reference to section 62. Then section 67, in general, a company is not allowed to give any kind of loan or assistance to its members for acquiring the company's own shares, rightly so, to protect the interest of the company as a whole. But this particular provision of section 67 will not be applicable to certain private companies. This is not applicable to all private companies, only to specific private companies who comply with all the three conditions, not any of the three, all the three conditions, that the private company's share capital is not held by any other body corporate. So you have to just see the list of members. There should be no other body corporate as a member. Only individual should be a member of that company. The borrowing of such company from bank or financial institution or any other body corporate is less than twice its paid up share capital or 50 crores, whichever is lower. And such company is not in default in repayment of the borrowing subsisting at the time of making transaction under this section. So a private company fulfilling these three conditions is not required to comply with the provisions of 67. The restriction on giving financial assistance would not be applicable to it. Of course, this provision generally is not used by the company. There are certain exemptions with reference to the acceptance of deposit. I have prepared 4 or 5 slides at the end of it, so I'm just skipping this slide for the time being. Annual return, with reference to annual return, you are supposed to file MGT 7 every year. That is to be filed within 60 days from the closure of the annual general meeting of the company. In this annual return, you are supposed to give information about the remuneration of directors and key managerial personnel. The table is given in the form itself, and the same has to be disclosed. The private companies, which are small companies, are given a relaxation. Those private companies who are small companies need not disclose the remuneration of directors and KMP individually. They are allowed to give aggregate amount of the remuneration by all the directors put together. But generally, this privilege also is not enjoyed because we also have to file MGT 9, which is attached to the director's report. And in MGT 9, in any case, we have to give the complete information. Regarding signing of the annual return, the clause says that annual return of a company has to be signed by a director and the company secretary of the company where there is no company secretary, by a company secretary in practice. So this is the general norm. Then the section further says, provided that in relation to an OPC or small company, the annual return shall be signed by the company secretary or where there is no company secretary, by a director of the company. This part has been amended for certain private companies. And it says that in relation to an OPC or a small company or a private company, if such private company is a startup, so only those private companies who are registered as a startup, the annual return shall be signed by the company secretary or where there is no company secretary, by the director of the company. So in short, in other cases, it is to be signed by a practicing company secretary, but a private company which is a startup or a small company or a OPC, the annual return can be signed by 2 directors and not 1 director and 1 practicing company secretary. So banking on an external professional, namely the practicing company secretary, is not applicable to OPCs or small companies or private companies which are registered as a startup. A long list of privileges for a private company. These privileges were there in the old act. Pick up any articles of association of a company registered on or before 31st March 2014. You'll find that these provisions were redesigned by the companies concerned. Because in the old act also you were allowed to avail privileges on these sections, these provisions, by having an appropriate clause in the Articles of Association. This particular privilege of private companies was withdrawn in the Companies Act 2013, and through the notification of June 2015, government said, let's go back to the old era, and a private company now is given a privilege to design its own norms with reference to the provisions under section 101, 102, 103, 4, 5, 6, 7, and 9. For example, a private company can have its own article saying that an AGM or a general meeting can be called by giving 7 days notice. Because in the law, in the Companies Act 2013, it's 21 clear days notice, which is applicable to private company also. But through the Articles of Association, this period can be reduced only in case of a private company. Attachment of explanatory statement, you are supposed to attach a statement relating to all special business items. This privilege also can be availed by a private company by having an appropriate article of association, article in the articles saying that company need not annex any explanatory statement to the special business item. Same way for quorum, chairman, proxies, voting rights, voting by show of hands, demand for poll, the private companies are given the liberties. A question which is normally raised is that what if the privilege on these sections was being availed by the companies who were incorporated on or before 31st March 2014? Can the companies continue availing these privileges based on the old Articles of Association? Well, the answer is no, because these privileges can be availed by a private company only if the articles are redesigned on or after 5th June 2015. So any article giving relaxation to a private company relating to issuing short notice or doing away with the requirement of explanatory statement, etc., will not be able to avail unless the articles are again amended. And therefore, it's not fair to rely on the old privileges which were stated in the Articles of Association of the company under the old Act. Section 117(3)(g). Those who are into filing would remember that from 1st April 2014 to 15th June 2015, we were filing practically an MGT 14 for every private company every other week. Because section 117(3)(g) says that all the resolutions passed by a company in pursuance to section 179(3) needs to be filed with the registrar of companies by filing form MGT 14. And it was really becoming a pain because a large number of private companies do not have the infrastructure, they do not have the team to take care of such filings. And these, what are these provisions? 179(3) says that certain powers are to be exercised by the board of directors in its board meeting only, like issuing shares, like buyback of shares, like making loans, making investment, making borrowings. All these provisions are to be exercised by the board of directors of a company in the board meeting only. You cannot pass these resolutions through circulation. And as and when you pass these resolutions in a duly convened, properly held board meeting, you are supposed to file the relevant resolution by filing form MGT 14 within 30 days. This particular compliance has been waived in case of a private company, and effective 5th June 2015, the resolutions passed by a private company under section 179(3) need not be filed with the registrar of companies, a major relief to the private companies. Eligibility of auditors, I think I should not discuss because this is something which is your domain. Rather, you can tell us, the company secretaries, as to how this provision is to be complied with appointment of auditor. And I'm sure every chartered accountant is availing this privilege. Another one also connected to the audit report, section 143 bracket 3 bracket 1. You, in case of a OPC or small company or a private company whose turnover is less than 50 crores, etc., etc., there is no need for auditors to comment on the adequacy of the internal financial controls. Section 160, again, another section which created problems for us in the year 2014 and up to 5th June 2015. Section 160 says that if a person is to be proposed as a director for the first time to be appointed in a company, you are supposed to get a requisition for the person's appointment as a director along with a fee, which can go to 1 lakh rupees. This fee has to be received by the company. The person's nomination would be placed before the members. If the person is appointed, this amount will be refunded. If the person is not appointed, the amount would be forfeited. This was creating problem because in case of a private company, you don't have public shareholders where they would like to nominate their representative to be appointed as a director, etc., etc. And therefore, the notification says that this particular section shall not be applicable to a private company. And therefore, in a private company, if a person is to be appointed as a director in the annual general meeting, you just have to take a requisition from a member proposing somebody as a director. And once the name is approved by the members by way of a resolution, the same would be, the appointment would happen. Connected section 162. 162 says that appointment of a director has to be voted individually. If you are to appoint 3 directors, you are supposed to pass 3 separate resolutions for appointment of a director. This section, according to the notification, will not be applicable to a private company. But in any case, I'm sure as a good governance practice, every private company is proposing the appointment of a director in the individual capacity, and no group appointments are ever proposed. However, a formal exemption has been given. With reference to the meeting of the board of directors, this is the original provision was giving some exemption or relief to a OPC or a small company or a dormant company. In any case, they were supposed to hold 2 board meetings in a year. In general, a company has to hold 4 board meetings. And with the condition that the gap between 2 board meetings should be not less than 120 days. This provision was relaxed with reference to OPC, small companies and dormant companies, saying that these companies can have 2 board meetings in a year with a condition that not less than 90 days gap would happen. At least 90 days gap would be there in 2 board meetings. Now, according to the notification, this privilege is reworded, and it says that an OPC, a small company, a dormant company, a private company, only if such private company is a startup, shall be deemed to have complied with the provisions of this section if at least 1 meeting of the board has been conducted in each half of a calendar year, and the gap between 2 meetings of not less than 90 days is ensured. So, in addition to the companies listed under section 173 bracket 5, they have also added one more category of a private company which happens to be a startup. A normal private company is required to hold 4 board meetings in a year. But if it happens to be a startup, or if it is a dormant company or a small company or an OPC, then only it can enjoy this privilege of holding 2 board meetings in a year. But again, subject to a condition that at least 90 days gap should be there in those 2 meetings. You cannot hold a board meeting on 30th June and the next board meeting on 1st July and say that, okay, we have complied with the relevant requirements. Quorum for the meetings of the board of directors, section 174 bracket 3. The provision reads as under: where at any time the number of interested director exceeds or is equal to 2/3 of the total strength of the board of directors. The number of directors who are not interested directors and present at the meeting being not less than 2 shall be the quorum. So in general, in a company, the quorum has to be a disinterested quorum. But in case of a private company, interested directors are to be treated. So now the privilege which is given is that this particular section shall apply with the exception that an interested director may also be counted towards the quorum in such meetings after disclosure of his interest pursuant to section 184. And 184 says that if a director is interested, he is supposed to disclose his interest, and then he is not supposed to participate in the proceedings. He is supposed to move out of the room where the board meeting is happening, because the item is such where he has a direct or indirect interest. Section 180, perhaps the biggest relief which we got through the notification of 5th June 2015 was exemption from compliance with the provisions of section 180. Earlier, we used to have section 293, 1A, B, C, D, E, which was applicable only to public companies. That section 293 became section 180 in the new act. In 293, we were supposed to take approval of the members by way of an ordinary resolution, but in the new act, the approval of the members is to be taken by way of a special resolution. And those resolutions are to be filed by filing form MGT 14 within 30 days. This section shall not be applicable to any private company. I repeat, this is perhaps the most welcome privilege which has been granted through the notification of June 2015. Why? Because section 180 talks of specific powers which are to be used by the board of directors only by getting prior approval from the members. It relates to, in short, like to sell, lease, or otherwise dispose of the whole or substantially whole of the undertaking of the company, or to borrow in excess of the company's paid up capital and free reserves, or to accept certain borrowings. Now, these resolutions were to be taken before acting on the relevant activity. Now, in case of a private company, there is no need to take such approvals. Of course, we are facing practical difficulties. I'm sure many of you must be facing this difficulty. The bankers, when they give any loan, they insist for a resolution under section 180. Because, as I said earlier, if a company wants to borrow in excess of its paid up capital and free reserve, it is supposed to have prior approval from the members by way of a resolution that it is allowed to borrow in excess of these thresholds. Though the section is not applicable because of this notification to a private company, the bankers insist. In such cases, there are two remedies. Either we give them a written undertaking that section 180 is not applicable to a private company pursuant to this notification, and therefore we have not taken approval by from members. Some bankers still insist that no, as a precautionary measure, you take approval. In those cases, we have no option but to call a shareholders meeting, take their approval, file the resolution with the registrar of companies by filing MGT 14, and give a copy of the resolution to the bank, because ultimately they are funding the company. And if the funds are needed, you need to go for certain compliances. Disclosure of interest by directors, section 184(2), as I said earlier. In general, an interested director is not supposed to participate in the proceedings. But in a private company, an interested director is allowed to participate. Of course, he has to disclose that I am interested in this particular resolution. Loan to directors, etc., section 185. Another big relief. Section 185 talks of making of loans by a company to certain other entities or individuals. It is borrowed from Section 295 of the old Act, and all private companies virtually were finding it difficult to comply with the provisions of Section 185. Then, based on their representations, the relevant rules were amended and certain conditions were imposed, and it was said that, okay, subject to certain conditions, a private company is allowed to give loan, etc., to directors and connected entities. But through the Amendment Act of 2017, Section 185 is totally replaced. The old Section 185, as it was given under the Companies Act 2013, has been substituted through the Companies Amendment Act of 2017. But if you go through the notification of June 2015 says that Section 185 will not be applicable to certain companies who are private companies, and the private companies who are eligible to avail exemption under Section 185 are those private companies who comply with the following three conditions. A private company in whose share capital no other body corporate has invested any money. That means the private company does not have a company as its member. The borrowing of such company from banks or financial institution or any other body corporate is less than twice its paid up share capital or 50 crores, whichever is lower. And the company has not defaulted in repayment of such borrowing subsisting at the time of making transaction under this section. All private companies who are satisfying these three conditions are exempt from the restrictions imposed under Section 185. But there are people who take a view that the exemption notification was issued by the government on 5th June 2015, saying that 185 will not be applicable to a private company if it complies with the following conditions. The said section has been totally substituted, and therefore the new section has to be complied with by a private company because no fresh notification giving the exemption has been released. This viewpoint is a very, very narrow viewpoint. Most of the professionals are of the view that the old notification of 5th June 2015 will hold good, despite the fact that Section 185 has been totally substituted. I personally feel, I'm with the majority, that a private company which complies with these three conditions need not follow the restrictions given under Section 185, which talks of, like, subsection 1 of 185 says that a private company, rather a company is not allowed to make any loan to certain categories of individuals. It is allowed to make loan to certain categories of companies subject to prior approval from the members. Subsection 3 talks of giving loan to certain directors, etc., subject to certain compliances. This whole section is not applicable to a private company which satisfies these three conditions. And I personally feel that about 50% companies in India would fall into this particular bracket where they are in a position to satisfy all the three conditions, and therefore they should avail and this privilege. Related party transactions, not much relief, but a relief is that an interested member is allowed to cast a vote as and when the related party transaction is presented to the members for their approval, which happens if in certain cases a company is supposed to take approval from the members by way of a resolution. Appointment of managing director, whole-time director or manager is not provisions relating to 196 bracket 4, 196 bracket 5 are not applicable to a private company. A private company is free to give remuneration to its directors, to its managing directors. The better course of action would be that you have an enabling clause in the Articles of Association saying that the board of directors of the company is free to decide as to how much remuneration is to be paid to the managing director or full-time director or the directors in general. Coming back to the provisions relating to acceptance of deposit by a private company, if you read the notification and if you read the relevant rules and you combine the two, you come out to certain conclusions with reference to the privileges. Section 73, which is the lead section of acceptance of deposit, it's headed as the title of the section is Prohibition on Acceptance of Deposit from Public. So from that perspective, there is a prohibition as far as the acceptance of deposit from public is concerned on any company. But if you go through the rules, certain privileges are given to a private company. And if you go through the exemption notifications of June 2015 and June 2017, you get to know of certain privileges. So a combined reading of the company's acceptance of deposit rules 2014 and the exemption notifications of June 2015 and June 2017, we come to the following conclusion. With reference to quantum, rule 3 bracket 3 of the company's acceptance of deposit, and I'm sure the chartered accountants are fairly familiar, rather fully familiar with company's acceptance of deposit rules because of the prominence given to this set of rules under earlier Mao Caro and then Caro every time it is released by the government. A private company may accept from its members money is not exceeding 100% of aggregate of the paid up share capital, free reserve and securities premium account. Let me just put a footnote here. A private company is allowed to accept deposits from directors and their relatives without any restriction whatsoever. Rather, deposits from directors and their relatives are not treated as deposits within the meaning of the company's acceptance of deposit rules 2014. We are talking about the privileges given to a private company with reference to acceptance of deposit from its members. Acceptance of deposits, I repeat, from the directors or their relative is exempt deposit, is not even a deposit.
Sir.
Yeah.
Sir, in this, is there a condition like the directors or their relatives should be giving those funds out of their own capital?
Yes,
and
it has to be from their own fund and not from the borrowed money.
So basically what the capital is standing in the account of the director, only that much amount he can give.
Yes. It was there in the old law also. It is there in the new law also. And this is a query raised by practically every person.
Exactly.
Yes.
This is the biggest bone of contention.
Yes. No, it has to be. And that's why auditors, what the auditors can do, they are not supposed to go for a fishing expedition asking for their passbook and all. They are just supposed to take a declaration that the money given by me is out of my own fund and not from the borrowed funds. That declaration would be a sufficient compliance. But yes, if you through other circumstantial evidence prove that you were aware that the money belongs to somebody else which has come to the director's account, in that case, that would not be a proper thing to do.
Okay, sir. Okay.
Yeah. Again, with reference to limits, it says a private company which is a startup is allowed to accept deposits from members up to 10 years of its incorporation. By the way, it was 5 years. Only in the last month, in September 2020, they have increased it to 10 years. Or a private company which fulfills all the following conditions. So in short, the maximum limit, that is deposit from members, shall not be applicable to following private companies. One, startup, and the other, a private company which fulfills all the 3 conditions. The company should not be an associate or a subsidiary of any other company. The borrowing of such company from bank, financial institution, or any body corporate is less than the twice of its paid up share capital or 50 crores, whichever is less. And such a company has not defaulted in the repayment of such borrowing subsisting at the time of accepting deposit. This exemption is given not under the rules, but under the notification. The previous limit exemption was given under Rule 3 bracket 3. this exemption is given under the notification to specific private companies. You can say small private company or startups. Then those private companies who want to avail this privilege, they are also given an exemption from compliance with the provisions relating to 73(2) A to E. Now, if you read A to E, it talks of filing of statement in lieu of advertisement with the registrar of companies, or dispatching the copy of that statement to all the members. Those norms are not applicable to a private company if and only if it accepts deposits from its members, which is not in excess of 100% of the paid-up share capital, free reserves and security premium account, or a private company which is a startup company for 5 years from the date of its incorporation. Now, there are two different. If you read the notification, it talks of 5 years. If you read the rules, it talks of 10 years, because the rules have been amended and corresponding amendment has not been made in the notification. Perhaps it would follow shortly. So the formalities relating to provisions under section 73(2) A to E, I repeat, relating to filing of the statement in lieu of advertisement with the registrar of companies, sending it to all the members, those provisions are not to be complied with by a private company if it's accepting deposits through this notification rules. And the third condition to avail this, a company which fulfills the following conditions, namely which is not an associate or a subsidiary company, if the borrowings of such company from the bank or financial institution or any body corporate is less than twice its paid up share capital, or 5 crore, whichever is lesser, and such company has not defaulted in the repayment of such borrowings subsisting at the time of acceptance of deposits. So to the extent possible, they have tried to harmonize the language of the rules, company's acceptance of deposit rules, and the notification of 5th June 2015 and the July 2017. Something which is important for the auditors and which is generally unnoticed. Rule 16 capital A of company's acceptance of deposit rules. Every private company shall disclose in its financial statement by way of notes about the money received from the directors or relative of directors. Many times we receive the draft final audited accounts, and this is a lapse which is pointed out for the first time when the company accepts. These information are not disclosed. It's essential for a private company, if it has accepted, yes, monies accepted from directors or the relatives of directors are exempt for the purpose of calculations, etc. They are exempt deposits. Our disclosure is mandatory under Rule 16 capital A. And with reference to section 134, the Companies Accounts Rules 2014 talks about a detailed disclosure about deposits accepted by a company. The details relating to deposits covered under Chapter 5 accepted during the year remained unpaid or unclaimed as at the end of the year, where there has been a default, information thereof, and detailed information are required to be disclosed in the director's report. So disclosure about the deposits has to be made not only in the notes to the accounts under deposit rules, but also in the director's report, which is to be prepared by the company. There are certain other provisions which a private company needs to know, or which are given in different sections or rules. I tried to collect as many as I could. One is about the commencement of business certificate, section 10A. This section was there in the original Companies Act 2013, but then was removed by Companies Amendment Act of 2015, but again introduced through the Companies Amendment Act of 2017, but brought into force from 2nd November 2018. It says that every company having share capital shall not commence any business or exercise any borrowing power unless a declaration is filed by the director within 180 days of the date of incorporation of the company form INC 20A. And this declaration is mainly on acceptance of money from the subscribers. A problem which is faced by auditors of private companies in general, that the company was incorporated a long back and the members have yet to introduce the share capital money, what do we do, and all those kind of queries. This kind of problem would now be sorted out because of the introduction of this section 10A. Within 180 days, every member has to bring the subscription money and the declaration has to be filed. Normally, we file it as early as possible because without filing this declaration, the company is not allowed to commence the business and company is not allowed to borrow any money. And this form is also regulated by a rule which says about recognition from any other regulator. According to Rule 23 capital A, in case the company is pursuing objects requiring registration or approval from any sectoral regulator, like your company is to be acting as an NBFC or a capital market intermediaries, in that case, registration from the sectoral regulator also has to be received, and that registration has to be attached to the INC 20A. So in general, with INC 20A, we attach the bank statement of the company wherein the credits received from the members are shown. And in case company is to be registered with a sectoral regulator, the regulatory approval or registration certificate is attached. Publication of name of the company. Well, thanks to the active norm which was brought in force last year, almost all companies have complied with this provision, but it needs to be repeated. The name of and address of the company has to be painted or affixed outside the registered office of the company where the business is carried on. On and off, we keep reading media reports where small private companies are used to do some activity which otherwise is not to be made known to the people belonging to big business houses. And there, the media people would make first comment is that the name and address of the registered office of the company was not displayed outside the registered office. So even journalists are aware of the provisions under section 12(3) of the Companies Act. And other thing which needs to be noticed is that the name, address and registered office of the company, its corporate identification number with telephone number, etc., should appear in all business letters, billheads, letter papers, etc., We have seen people issuing notices under Consumer Protection Act telling the company that there has been a deficiency in service rendered by you or defective goods sold by you. And in addition to thereto, they say that your cash memo does not carry the corporate identification number on the cash memo. And therefore, it is a contravention of the provisions of section 12(3). So these small things do create problem if there are some other difficulties. Other provision which is generally ignored by people is not mentioning the director's identification number. We file certified true copy of the resolutions time and again with the registrar of companies and various authorities. This certified true copy of the resolution has to be certified as true by the director concerned. He does it religiously. He puts his signature also. Nowadays in pandemic, we are putting the digital signature, but the director's number, identification number is omitted, is normally not printed. That is contravention of section 158 that needs to be kept in mind. You have filed a form MGT 14 with a resolution signed by a director without mentioning the DIN, because you see the relevant rule, provided that any correspondence physically or electronically and documents to be filed by any person shall contain name, designation, address, membership number, or DIN, as the case may be, of the person signing such document, and make sure correctness thereof, and in no case correspondence merely with signature and writing authorized signatory shall be acceptable. This is given under Rule 7 of the Companies Registration Offices and Fees Rules 2014. All those chartered accountants who are acting as CFO of a company, when they're putting their signature as CFO on documents which are being filed with the statutory authorities, they are supposed to write their membership number of the Institute of Chartered Accountants of India. That is something which needs to be kept in mind, and especially with reference to DIN, the directors, they have to write the DIN. With reference to transfer of shares, section 56, there are two special features connected to the private companies. The transfer form for transfer of shares needs to be lodged with the company within 2 months of the execution. There is no now system of getting the transfer form approved by the prescribed authorities as used to happen in the old law. So now what is to be kept in mind is that within 2 months of its execution, and the company is supposed to approve the transfer within 1 month of its lodgement. But again, here what we have to keep in mind is that 2 months from execution, but then again, every transfer form has to be stamped with appropriate stamp value. That is 0.25% of the net value, or the valuation as valued by the experts. And that stamp duty in case of Maharashtra at least is being paid through franking. Now that 2 months has to be correlated with the franking impression, because only after franking you can do the execution, and only after execution you can do the transfer. Section 91 talks about the closure of register of members. Section says a company may close. That means a company, whether private or public, is given an option to close the register. Earlier it was a mandatory provision, a company must close. Now they have amended, it's optional. Then if you go to the rules, the rule says if at all a company decide to close the register of members, it's optional, but if they decide to close, in that case, the closure notice is to be given to the members of public by way of advertisement. So if at all a company closes its register of members, it has to mandatorily release an advertisement in the newspaper at least 7 days before commencement of the closure. Now when we go to rule 2(2), a specific exemption is created for a private company. And it says that a provision contained in sub-rule 1 shall not be applicable to a private company. And therefore, number one, a private company is not mandatorily required to close the register of members. If at all it decides to close its register of members, there is no need to release an advertisement in the newspaper. So there's a big relief for a private company. A private company, even if it doesn't have much activities, is supposed to maintain some registers. There are so many registers which are required to be maintained, but few registers which practically every company needs to maintain would be the register of renewed and duplicate share certificates. And by the way, format of these registers are given in the Act, either in the form of a form number or in the appropriate rules. So the columns which are to be prepared cannot be designed by the company on its own whims or fancy. It has to be based on the designs prescribed under the forms or the rules. Form SH2 gives you the format of the register of renewed and duplicate share certificate. Every company is supposed to maintain a register of deposits. Now, for that, no format is given through form DPT, but the columns are suggested in the deposit rules that the company has to maintain the register, and the register following information are to be disclosed. Then a company has to maintain the register of charges. Format is given in form number CHG 7. Let me add here that a number of forms which are to be filed by the registrar of companies, by the company with the registrar, also carry the identical number, form CHG1, CHG4, CHG9. Those forms which are to be filed are known as e-form number, electronic form number, and they are to be prepared electronically, they are to be signed digitally, electronically, and they are to be uploaded electronically. But there are certain forms which are given under the rules are not to be filed, but they contain only the format. Like for example, all the forms appearing on this screen are not the e-forms, they are just form which gives a format of the appropriate register. So register of charges, we refer to form number CHG 7. which gives us various columns. Register of members, form MGT1, every company needs to have. Register of directors and KMP, Rule 17 gives you the information. Notice of interest of directors, MVP1, obviously every chartered accountant, every auditor would insist for MVP1 before signing the audit report. Register of loan, etc. has to be prepared in the format given under MVP2. These are the registers which are to be practically maintained by every private company. There is another provision with reference to section 138. The provision says that every company has to appoint an internal auditor who may be either a chartered accountant or a cost accountant or such other professional as may be decided by the board. And the term chartered accountant or cost accountant shall mean a chartered accountant or cost accountant as the case may be, whether engaged in practice or no. So even a practicing chartered accountant or a cost accountant can be appointed as an internal auditor under section 138. Now, what is special with reference to a private company? The Companies Accounts Rules 2014, Rule 13 says that appointment of internal auditor is mandatory in case of a private company only and only if the private company has a turnover of rupees 200 crore or more during the preceding financial year, or the outstanding loans or borrowings from the bank or public financial institutions exceeds 100 crore or more at any point of time during the preceding financial year. So compliance with section 138 relating to mandatory appointment of an internal auditor is mandatory only in case of the private companies falling into these two categories. And remember, as and when an internal auditor is appointed, you are supposed to comply with section 117, which requires you to file form MGT 14 within 30 days from the date of appointment. Now, the appointment or cessation of internal auditor does not appear in the section 117. But if you see section 117, the last clause says such other events as may be specified. And the rules tell you that as and when an internal auditor is appointed or he ceases to hold office, the intimation thereof has to be given to the registrar of companies by filing form MGT 14. So companies with this large turnover or borrowing should comply with provisions under section 138. Another provision which, at least in the initial 1 or 2 years, was not followed by maybe 70–80% private companies. Rule 14 of the Companies Audit and Auditors Rule 2014 says the remuneration of such cost auditor shall be ratified by shareholders subsequently. In short, the Companies Act says that in certain companies who are engaged in manufacturing, production, processing, etc., activities, in certain cases, they are supposed to get their accounts audited by a cost auditor. The cost auditor is supposed to give his report. The cost auditor is appointed by the board of directors subject to approval from the central government. He will give his report. The report has to be filed with the registrar of companies. Everything is fine. There is one compliance which is spelled out in the rules, and that's why it initially went unnoticed, that the remuneration of the cost auditor shall be ratified by shareholders. So remuneration is to be decided by the directors, is to be given by the company to the cost auditor based on the fixation done by the directors. However, its ratification is mandatory. That has to happen in the annual general meeting. The companies sometimes file the AGM notice with the registrar of companies, though it's not at all mandatory, while filing MGT 14, because in the annual general meeting, some special resolution must have been passed. And we take inspection of various companies, private companies, where this notice is appearing in the MGT 14, and we find that the item relating to ratification of cost auditor's remuneration is missing. There's a grave contravention. Of course, till the time it is not noticed by the regulatory authority, we don't have to really worry. But this is something which needs to be kept in mind. Directors, with reference to directors, there are privileges given to the private companies in the Act. Appointment of women director is not mandatory under section 149. Appointment of independent director again is not mandatory in case of a private company under section 149. In fact, when you appoint a director in a private company, you are supposed to file form DIR 12. When you file form DIR 12, prepare to a DIR 12, you are supposed to put as to what category this individual would belong to. And there are three options, scroll down. One is promoter, other is professional, and the third is independent. In case of a private company, the option of independent director cannot be availed by a private company, which means in a private company, you are not supposed to appoint this. However, certain other regulatory norms like maybe RBI regulations or SEBI regulations may require a private company to appoint an independent director. In that case, one can be appointed, and there a letter can be attached to form DIR 12 saying that since the option is not activated in case of a private company, we are clarifying that the appointment is as an independent director. Section 152 regarding retirement of directors by rotation is not applicable to a private company. Constitution of audit committee, nomination and remuneration committee, stakeholders relationship committee is not applicable to a private company. Section 177, 178, etc. give clear relief, but there is a check in the rules with reference to section 177, which relates to audit committee. If you see the relevant rules, let me first read the provision of section 177(9), which relates to constitution of an audit committee by certain companies. This subsection says that every listed company or such class or classes of company as may be prescribed shall establish a visual mechanism for directors and employees to report the genuine concerns in such manner as may be prescribed. So the section says a listed company or such class or classes of companies as may be prescribed. And what's the relevant provision? Visual mechanism, again connected to the audit profession. Visual mechanism under subsection 9 shall provide for adequate safeguard against victimization of persons who use such mechanism and make provision for direct access to chairperson of the audit committee in appropriate or exceptional cases. So practically, visual mechanism is something which is overseen by the audit committee. Now, when we go to the applicable rules, Rule 7 of the company's meetings of board and powers rules says, company belonging to the following class shall establish a visual mechanism for their directors and employees. And category B, a company which has borrowed money from banks and public financial institution in excess of rupees 50 crores. The word which is used here is company, not a public company. And no exemption is given in any notification. Therefore, even if it's a private company, if it has borrowed money from banks and public financial institution in excess of rupees 50 crores, it is supposed to nominate a director to play the role of audit committee, because in a private company, 177 will not be applicable. In a private company, you do not have to constitute an audit committee. And therefore, somebody has to be made responsible for compliance of or for enforcement of visual mechanism. And therefore, the method has been prescribed in the rules. That in a private company, I repeat, this part which I'm reading relates to only a private company. The board shall nominate a director to play the role of audit committee for the purpose of visual mechanism, to whom other directors and employees may report their concern. Because in a public company, in any case, in such cases, you will have an audit committee. The visual mechanism shall provide for adequate safeguard against victimization of employees and directors who avail of the visual mechanism, and also provide for direct access to the director nominated to play the role of. Again, here, in case of a listed company, it would be access to the audit committee. But in case of a private company, because there is no audit committee, access to the directors nominated to play the role of audit committee. Time is short, therefore I'm a little fast so that we can have 5-7 minutes for discussion. Disqualification or vacation of office. Section 164 talks of disqualification of a director. Section 167 talks of the happening of certain events when a director would be automatically required to vacate his office. In both these connections, private companies are given the privilege under the Act itself. Section 164(3) says that a private company may by its articles provide for any disqualification for appointment as a director. In addition to the disqualifications given under sections 1 or 2, which relates to non-filing of accounts for 3 years or non-filing of accounts, annual return, or doing something which makes the person of unsound mind, or if one is convicted for an offense involving moral turpitude, etc., etc., or not attending board meetings or not disclosing their interest. Section 167(4) says a private company may by its article provide for any other grounds for the vacation of the office of a director in addition to those specified in subsection 1. So here also, private company is given this privilege by using its articles of association. Appointment of key managerial personnel, section 203. The relevant rules are known as the company's appointment and remuneration of managerial personnel rules. Forms prescribed under these rules are known as MR1, MR2, MR3, that is managerial remuneration 1, 2, 3, etc. Rule 8 of these rules says that private company need not have whole-time KMP. So a private company need not appoint a whole-time director or a managing director or CEO, CFO, etc., etc. But Rule 8A, it says that every private company which has a paid-up share capital of rupees 10 crore or more shall have a whole-time company secretary. So a private company need not have a managing director, need not have a whole-time director, need not have a CEO, need not have a CFO. But if its paid-up share capital is more than 10 crores, in that case, it shall have a whole-time company secretary to ensure that since its operations are large enough, which would prompt the company to make various compliances, a compliance officer takes care of the legal compliances. Only one special issue, which I always talk whenever I talk on the Companies Act. Little old slide, but I've been using it for last 4-5 years, and the situation still holds good. This is the view signatory detail picked up from the Ministry of Corporate Affairs portal mca.gov.in. If you see the designation of the person, it's additional director. And if you see the date of appointment, it's 2nd June 2009. Now, additional director, by definition, is supposed to hold office only till the conclusion of the next annual general meeting. If a person is appointed as an additional director today, he will hold office till the next annual general meeting. But in case of this company, and there are thousands of such companies, I repeat, not hundreds, thousands of such companies where additional director was appointed in the year 2010, 11, 12, 14, 15, 16, 17. He or she should have held office till the conclusion of the next annual general meeting, but still, according to MCA portal, he is still continuing as an additional director. This is a contravention. Technically, after the closure of the next annual general meeting, all the documents which are signed by this person who is designated as additional director for the purposes of the Ministry of Corporate Affairs, his signing authority is misuse of the authority. He is not authorized. And I've seen such people signing financial statement duly audited by the auditors. And therefore, my request to the auditors, my chartered accountant friends, that wherever you are acting as an auditor, just check the view signatory details. You'll find the information, it's available free of cost. You don't have to pay. It's public information. The DIN number appears, the full name appears. By the way, now they don't write the residential address. Till 6 months back, we used to get the residential address of all the directors of the company. But because of the fact that the directors started receiving notices from the aggrieved consumers of the company under Consumer Protection Act, holding the directors personally responsible, they must have made a representation that let our addresses not be shared with the public. I remember when my cell phone started giving me the troubles, I wrote to all the directors of the company. I picked up the addresses from this very part of the Ministry of Corporate Affairs, and I wrote to all of them. Within 3 days, my grievance was redressed. So they have stopped giving information about the residential address. But if the designation appears as additional director, please ensure that you file Form DIR 12. You have to do a simple thing. The designation has to be changed from additional director to director. I'm sure the regularization was done, but what is left out is the filing of Form DIR 12. And fortunately, we have CFSS now. A scheme is on. Even this company, which is appearing on the screen today, I checked its database yesterday also. These people are still shown as director. If this company files a DIR 12 even today, or till 31st December 2020, the filing fee to be paid would be only 600 rupees, not 7,800 maximum, and not and there would be no prosecution, etc., etc. So all the friends who are aware of such cases are requested to advise their clients that please regularize their appointment in the year concerned in the very next AGM. And I'm sure it must have been done. Only lapse is that the form has not been filed, because otherwise additional director has all the powers to do everything. However, if MCA is not aware about his regularization, MCA would assume, rightly so, I can assume that in this case, the first named director was out from the company on 30th September 2009. And the second named director also was, again, because he was appointed in November 2008, he was out from the company on 30th September 2009. So this is something which needs to be taken note of. Well, with this, I am through. I know not much time is left. Still, if we can have some interaction. Looks like organizers are not. Hello, Nikunj.
Yes, sir.
Yeah.
Sir,
Time is.
one query is there.
Yeah, yeah.
Wanted to understand about relaxation compliances under COVID situation under Companies Act.
This is the best time. Just take a stock of all the compliances which you did in last 5 years, except MGT 14, which needs to be filed within 270 days. All forms can now also be filed by paying normal fee. So it's just a matter of taking stock, and wherever you feel, I tell you, I give you a simple example. In the year 2014, every company was supposed to file Form MGT 14 as and when the directors disclose their interest. If you take a review of the filings done by a company, there is every possibility that those MPP1 were not filed with the Registrar of Companies through MGT 14. In 2014, even a private company, when its accounts were audited and the director's report was approved, the resolution relating to signing of the audited accounts by the directors and the resolution relating to signing of the director's report under section 134 were required to be filed with the Registrar of Companies. I'm talking of 2014. Till 5th June 2015, MGT 14 was to be filed. A stock taking can be done. Well, again, I'm sorry, MGT 14 will not be accepted in the scheme. Otherwise, all forms can be filed now before 31st December. It's a golden time. Let all the defaults be rectified and the companies be brought to normal platform, kind of. It's like zero non-compliance with reference to filing error. Yes,
Sir,
one thing which needs to be shared is that you are allowed to sign the audit reports digitally. The institute has come out with an advisory in the month of April itself, Chartered Accountants CA Institute has come out with a advisory saying that the audit reports can be signed by the Chartered Accountants digitally. But what is missed out is the fact that in the digital signature, the date and the time of signature also appear. Sorry to say, I've seen in some cases, the date on which it was to have been signed was some other date, and the date on which the digital signature has been affixed is something else. That need not be allowed to happen, because you are creating a very strong evidence that this report has been signed on a particular day. Even time appears. Is 3rd November 2020, 17.20.16 seconds. In that case, that document should have been released on 3rd November only. You cannot say that it was approved by the auditor on 20th October or so. That backdating kind of thing, which we called in our B2D language, should be strongly avoided. It will create problem at a later stage and not now, because time is very much visible.
Sir, there is one more query.
Yeah.
That is relaxation under SEBI and MCA for board meeting, AGM and annual report filing. Anything which we can get so that we can tell our clients.
See, for AGM, the notification was received somewhere on, I don't remember the exact date, but I think it was on 27th September 2020. 27th September, you were told that you are allowed to hold AGM. Up to 31st December time was extension was given by every registrar of companies. If your accounts were audited before that date, in that case, well, let your director's report and audited accounts and audit report be signed on any day which is before 27th September. But let your notice convening the AGM be signed on 27th September or thereafter only. Because if your audited accounts were signed on 5th September, your director's report was signed on 5th September, your AGM notice was signed on 5th September. In that case, how could you visualize that AGM extension would be there and you hold the AGM on 10th October? That is happening in a number of cases. So in such cases, let the audited accounts and director's report be approved on the date when they were approved, say 5th September. But AGM notice be approved by calling a fresh board meeting on 27th September. And you are allowed to do it. There is no compulsion that accounts, director's report and notice should be signed in the same board meeting. You can have 3 different dates for holding board meetings and approving these documents. Yeah. Because if you are approving the notice convening the AGM on 20th October, that means it's a clear case of backdating, which is not permissible, which is not allowed. Yes, if you have filed Form GNL for extension of AGM before 5th September, in that case, you could say that we were expecting it. Otherwise, this is something which would be ignored by 90% of the people. And if a law is not complied with by 90% people, you can conclude that there is something wrong with the law itself and not by the people who are supposed to comply with it. It's a very loosely worded statement, but this is the practical situation. Listed companies, I'm sure, must have completed their AGM before 30th September. I don't think, because till 27th, nobody would wait. And in case of listed companies, you are supposed to give 21 clear days notice, which would exclude the date of dispatch, the date of receipt, and 48 hours for postal transit. Yes, you are allowed to send the notices by email. Still 21 clear days notice has to be given. You are supposed to also release a notice in the newspaper, especially if the meeting is to be held through video conferencing. So listed companies, I don't think will be able to avail, except rarest of rare case, that they would be able to hold the AGM somewhere in October.
Okay. Members, any other queries? You can post directly to sir or directly to me.
Yeah, my email ID is appearing. So
Yeah.
they can even mail the queries. Absolutely not a problem.
Okay, sir. So, thank you, sir. This was a wonderful session, and your explanation to every section are very informative and made it easy to understand. And thank you for resolving our queries. I request C.A. Sheetal Sharma to present formal vote of thanks to our today's speaker, sir. Sheetal, over to you.
Thank you, ma'am. It's a great honor to express our appreciation to such an eminent and renowned speaker, Surendra Kanstiya, sir. Sir, the way you have explained the statutory compliances with such depth of act is exemplary. I am sure our members have a lot of takeaways and an evening knowledge gathering. The cautions and the suggestions given by you are very timely. Sir, thank you so much for gracing this webinar and making us informed on the various statutory compliances with respect to private limited companies. The zeal with which you have taken us through the PPT is commendable. Thank you so